Investors are different. So every investor is looking for different things as they look to invest their money. So the first thing I would say is the strategy of the fund. Does it align to my needs as an investor? So different investors will look for different things. So for example, if I'm looking at an investment that I want it to give me a constant return, maybe every quarter or every half of the year, I'm going to look at maybe a fixed income investment like a bond. A bond will give me a fixed return maybe every quarter. So, and if maybe I'm looking at an investment where I want to be able to get my money, maybe it's my emergency fund, I look more towards a money market because I can get my money overnight. So different investors will look at different things. We have the time horizon. As an investor, you also want to determine how long do I want to put in my money in this investment. If it's like maybe 6 months, then you're not going to go the real estate way because real estate is more illiquid. So you're going to look at investments that are more liquid, as we said, like the money markets. They'll invest in more liquid asset classes. So those are some of the factors that investors can look at. And we also have other factors like the tax that is associated with the kind of investment that you're investing in. So we have, like currently we have the infrastructure bonds in Kenya, which normally they have not been charging any tax on the investment, on your returns. And we also have the other bonds that normally they charge the 15% withholding tax on the investment. So as an investor, you want to balance all those needs that you have, and also now look for the funds that have their strategy aligned with your needs as an investor. The first ones are, I would say they are more aligned with the market volatility. Under this, we have the interest rate risk, which mainly it will result when we have higher rates in the market than the time of your investment. So it will normally, when the rule of the thumb rather, when the rates in the market are higher, that means the bond prices are lower. So what does that mean to an investor who had bought a bond maybe before? That means if you want to sell your bond, you're going to sell it at a cheaper price than the price that you bought the bond at. So that is one of the risks that is associated with the fixed income market. And you also have the inflation risk. Under this, we can look at the real return more. So the real return, it will entail the return that you're getting from your investment. Maybe you're getting an 18%, and the inflation is currently at, we can just say 5%. That means your real return is the 18% minus 5%. So that will give you a 13% real return. So inflation is going to reduce the value of your investment. So for example, if you had invested in a bond that gives you a coupon rate, and we all know that a coupon rate is fixed for the tenure of the bond. So if you get that coupon rate when the inflation in the country is 5%, and now the inflation is increasing maybe to 9%, it means that the money that you're getting, the purchasing power is lower. So that is what we call the inflation risk in a simpler term. Because if you are getting 100,000 today when the inflation was 5%, and you're still getting the 100,000 when the inflation is 9%, the 100,000 is not the same value. So the purchasing power of the 100,000 is lower. So that's why we say the real return is lower when the inflation goes up. So just to note, the volatility of the market risk, the risks that come along with the volatility in the market, like the interest rate risk and the inflation risk, can be mitigated, or rather they can be reduced, because you cannot do away with risk at all. You cannot have an investment that is giving you a return with zero risk. It's impossible. So you can reduce the risk. The fund manager can reduce the risk by diversification. Diversification will reduce the risk that is associated with a certain investment in case it faces a negative volatility in the market. So if you have your fund investing in bonds which face the interest rate risk and also the inflation risk, then you can now diversify to include real estate. You can include the equities market, the stocks, which are less sensitive. So as an investor, what are some of the factors that you're going to consider for you to choose a fund manager? The first one for me would be the historical performance of the fund manager. You can just check for how long has the fund manager been in the market, what has been the returns the fund manager has offered to the clients. Like for example, Cytonn, we have served in the market, we have run our investments for a long period, and over the time we've managed to offer clients our returns that are above the market average. The second one would be the fees that the fund manager will charge you to manage your investment. Mostly the fees will range between 1% and 2%, but you can always check and confirm before you put in investment, and just make sure it's comfortable with you as an investor. Then the other one would be the team that is managing your investments. How qualified, how professional are they? So you also want to be confident with the team that you're choosing, and just make sure they are professionals and they're experienced in this field, because the investments market and the investments industry, it needs a lot of expertise in terms of making the best investment decisions that will give you the best return as an investor.